Dividend investors, bonjour. This is Mike Héroux, founder of Dividend Stocks Rocks and passionate investor. Today we're talking about Canadian banks, but not as the same way as I did when I reviewed their earnings. Rather, I'm going to show you how they fit in your portfolio for the next 20 years. Canadian banks are amazing. They have outperformed the Canadian market for the past 5, 10, 15, probably 25 years. But they're not all created equal. And today I'm going to present you my ranking. So we're going to go from number 6 all the way up to number 1 for my favorite bank for the next 20 years. But first, I want to bust some myth about Canadian banks. I know a lot of people love them, but you must know what's happening in there, and you must know everything about Canadian banks. So the first thing is, I see Canadian banks a little bit like salt for cooking. So if you've cooked before, you know that there are 3 special ingredients, right? Magical ingredients: butter, olive oil, and salt. When you master those 3, you can pretty much cook anything and it will taste good. So picture yourself building your portfolio the same way that you would cook a nice soup for fall, right? So nice pumpkin soup, something earthy a little bit. All the right ingredients to have something balanced and that will help you go through the fall and the cold time. So your portfolio is well built. You're cooking your soup. Everything smells nice. It's perfect. So you have a taste of it. And then you're just like, yeah, the taste is there, but needs a little bit more salt. So you grab the salt from the shelf and then you put a little bit in there, and there you go, you put RBC in your portfolio. So you taste it again and then you're just like, oh my God, it tastes so much better, because when you're adding a Canadian bank like Royal, you're adding muscle to your dividend yield, you're getting some growth perspective, and you have something that is like more than decent in terms of dividend growth on top of that. So you get all excited. And then you think, oh, I'm going to add all possible salt that I have, all kind of salts. So you're putting that pink salt, with the grinder, and then you're putting sea salt, and then you're putting a little bit of fleur de sel. And then you put salt in there in your soup, and then you're just all excited. And then you go RBC, TD, ScotiaBank, BMO, National Bank. And then you're just like, yeah, man, I have like 5 or 6 of the biggest 6 banks. Feels good. When you're going to taste it, it's just going to taste salt. It's going to be just saltier and not better. Why? Because if you just put all Canadian banks in your portfolio, you're just applying one of the principles of diversification. So unless you have like less than 20% in all those Canadian banks, then you're just adding yourself more trouble, because you have to follow up those 5 or 6 holdings every quarter. And if you don't do it, well, you know what? You just open yourself to a bad news one day because you haven't followed your stocks properly, and then something's going to hit the market and you're going to get hurt. I know a lot of Canadian investors have 4, 5, 6 banks in their portfolio. They love them because they have outperformed the market, but honestly, you're not helping your portfolio. You're just getting your soup saltier. Think about that. It's not the right approach to have a decent and well-diversified portfolio. In fact, you're better off with the top 2 or top 3 holdings, and it's going to be a lot better. We're going to get to it. But first, I need to bust another myth. The myth that all Canadian banks are created equal. They're all great, and you cannot go wrong with a Canadian bank. First, if you take the first 6 banks, technically, you'll do well. But what if I tell you that ScotiaBank, over the past 10 years, gave you a 60% total return, while National Bank has provided you with 250% total return? Do you really think that both of them are equally weighted in your portfolio and that makes sense? Not really. It would be like telling me, Mike, if you invest in any tech stocks, you'll do fine. That's not true. Some tech stocks are good, some tech stocks are less good, and some are just crap. I'm not going to discuss today Laurentian Bank and Canadian Western Bank, mostly because at DSR they are rated as sell. They were rated as sell way before the pandemic. We're talking 2018, 2019. Laurentian Bank is pretty much a convenience store, so you know what? A lot of people liked it for its yield. Now the dividend has been cut. So you're losing on terms of revenue. You're losing in terms of stock value. I don't know what you're doing there. I don't consider it as a bank. For Canadian Western Bank, the problem is they focus mostly in Western Canada, but even more in Alberta. And if you think that the oil sands is going to pick up right now, I have bad news for you. So Alberta's economy is not going to thrive, and they're a classic savings and bank loan, not exactly the best place to be when interest rates are super low. So I just don't see the appeal when you can have an opportunity to invest in such amazing banks as the top 6. So now here we go with our top 6, and on the 6th position we have CIBC. CIBC, you know what? Classic savings and loans again. You know, a lot of investors love it because it has a high yield and a relatively low payout ratio. But when you do the math, stock price is lower, brings higher yield. PE ratio is lower, higher yield, stock price is low, right? The thing is, CIBC doesn't have much growth vector in front of it. You know, with interest rates super low, interest margin will be squeezed, and then your only way out is to do more loans. I don't really think with the situation in Canada that's a smart idea. Now they can focus on the mortgage side because it's doing well. Housing market in Canada is doing well, so they could do well on that side. But you know, when your biggest growth vector is mortgages right now, I'm not too sure you're going to outperform the other banks, right? Finally, they have moved into a little bit more towards private banking and wealth management. That's a smart move, but they're a little bit late and they're smaller than other players in that market. So for those reasons, it stays at number 6. Now, number 5, ScotiaBank, the 3rd largest bank in terms of assets and market cap. ScotiaBank, a lot of people love it for its narrative. Best diversified bank, most international. Scotiabank for several, actually not years, but for over a decade, they have focused on growing outside Canada, especially more in Central America and in South America. So when you're thinking about Mexico or Chile, we all agree that their economy, their GDP growth is better than US and Canada, and their perspective moving forward is also better. So they should grow maybe at 3 or a 4% rate, while in Canada and the US it will be hard to do better than 1 or 2%. That was the narrative before the pandemic. So before the pandemic, they had that great story, but they never capitalized on it, and they never outperformed other banks, and they were not growing faster than them. You know what? Because it's a lot more complicated to do business in Central America. You know, it took several years and several misattempts for Canadian banks to enter the US markets. They had to make bad acquisition, and then they failed several times, and now they got how they do banking outside of Canada. When you look at South America and Central America, it's a lot more complicated than making loans in the US. And for that reason, it's going to be harder for them. Now, with the pandemic, it's even worse because countries with lower resources, weaker healthcare system are going to have a problem there a lot more than in North America. So for that reason, I think it's going to be very hard for Scotiabank in the upcoming years. And as I mentioned before, it is the worst performing stock over the past 10 years. I'm not expecting them to reverse that trend in the upcoming months and the upcoming years. Now, moving on to number 4, I decided to pick BMO. What I love about BMO is their focus on capital markets and wealth management. They were the first in the country to have their own ETF suites. They kind of like saw where the market is going, and they took like advantage of it. They were also among the first Canadian banks to make a move towards private banking with the acquisition of RS Bank in Chicago. So they're well established in the States. They're well established in wealth management and capital market. That's what I like about them. What I don't like about them is because of that focus, their revenue and earnings a little bit more volatile. Their dividend growth perspective versus the other five is lower. They have been trailing for that part, and I don't really like that. And when I compare when I compare companies in the same industry, and I realize that one is really lagging behind in terms of dividend growth, I cannot pick this one as a winner. So BMO is closing my bottom three. Now, moving on to the top three of my list. And so far, I don't own any of those banks, right? I don't own my number three either, which is TD Bank. TD Bank has an approach a little bit more like CIBC in terms of classic savings and loans, but they did it in a very nice way. Plus, they have 1/3 of their revenue coming from the US. So they really caught up that game from their southern neighbors. They know how they want to deal. They have a great exposure over there, and they obviously they have the largest amount of assets in Canada. They are focused on doing things simple, but doing them the right way. And this is why they're doing so well, and they have been doing so well for the past 10 years. They have strong wealth management as well. Their segment from Ameritrade did very well. Now they're selling to Charles Schwab's. So everything is running smoothly for TD. I'm not worried about them, but maybe the little downside would be high exposure to mortgages, especially in hot markets such as Vancouver, Toronto. Right now it's a positive thing, but at one point in time, if it cools down and then we have a housing bubble, then it's going to be a little bit harder for TD. Now, my top two favorite, I own both of them, and sometimes they're number one, sometimes they're number two, but right now my second favorite is Royal Bank. What I like about Royal Bank, well, first it's they're battling with TD to be the largest bank in terms of assets, so they're doing very well over there. They're well established across all Canada, but what is even better is only about 50% of their revenue are coming from classic banking activities. So only 50% is subject to the interest rate squeeze. The other 50%, we're talking about wealth management, capital market, and insurance. And they have been able to do lots of cross-selling across those segments. They are maximizing their presence in wealth management, and they had a huge deal with BlackRock for ETFs. So overall, they're doing very well. They have been outperforming the average bank in Canada in terms of market as well. And recently, in terms of earning, they have shown their strength also. So for that reason, this is my number two. I think it's going to be very hard for other banks to outperform Royal Bank at this point in terms of for an investor's perspective. A strong dividend growth policy in place. Obviously, don't expect any dividend increase for the rest of the year in 2020 from any banks. That's kind of obvious. I'm pretty sure they're going to just click on pause, wait a little, see how things go, see how their loan book is being affected, and then they may resume in 2020 and 2021 or 2022. But the dividend will be safe in the meantime. So now coming to my number one position, and I'm pretty sure you saw it coming, National Bank. National Bank is the smallest of the top six. A lot of Canadians, actually, if you don't live in Quebec, they're going to talk about the big five and they're going to just discard the National Bank, because National Bank is more like a supranational bank based in Quebec. Most of their assets are there, but they have focused on a lot of growth vectors to capitalize on their small size and their flexibility. So what they did about 20 years ago, they signed a deal with Power Corporation to do credit for clients at Great-West Life, Investors Group, London Life. So basically they did a lot of mortgages and then like line of credits. They did also investment loans. So that was one of their way to go in Western Canada without having to spend a lot of money on branches. Then what they did is that they founded private banking 1859. full disclaimer, I used to work there for a while. It is one of the fastest growing wealth management business in the country for several years. They have a very strong brand recognition over there. What they did also is, since they were doing a lot of loans in Western Canada, they actually opened private banking branches. So not regular branches where everybody can go, but just selling points where private consultants and private bankers could be there for their clients. They have been growing very fast through wealth management. They also very strong in capital markets, so they're very active on the market. This creates a little bit more of volatility, as it is the case with BMO, but overall they've been doing well, so they're making more money. And finally, they also have an international branch and US segment. In the international, they actually focus on Cambodia recently. They completed the purchase of ABA Bank over there. So they're trying to make things happen outside of Canada in terms of growth, but they've selected emerging markets in Asia instead of South America. We're going to see how it goes. It's not my favorite part of their business model. I'm a lot more involved in love with their wealth management and capital markets, and the fact that they're heavily based in Quebec. In the past, it has been some kind of a reason to lag a little bit behind, but over the past 10 years, Quebec has proven its resiliency. They're not dependent on energy to grow their economy, so they have an economy that is a little bit more similar to Ontario. They're doing well. So far in the pandemic, we have been hit with a lot of cases, but our economy seems to be on the way to recover a little bit faster than the other banks. So for those reasons, National Bank is my number one. 6 months ago, Royal Bank was my number one. So depending on the timing, I like both banks. So I hope that you have enjoyed this video. I would like now to know, what about your favorite bank? Is it ScotiaBank and you think that I'm in the left field with international stocks? Is it CIBC because they have the highest dividend yield possible? Or you agree with me that Royal Bank and National Bank are the best picks among Canadian banks? Let me know how many of those you have also. I'm very curious to know, what's the purpose, what's the point? Why do you have 4 or 5 Canadian banks in your portfolio? Do you really think it's helping you and it's getting you a better portfolio? Let me know in the comment, like this video, follow me, and until next video, stay invested.